Speaking of the world's top investors, the venture capitalist behind early stakes in Pinterest, Airbnb, and DraftKings is deploying new money into tech companies despite the tough market environment. Rick Heitzmann is a founder and partner at Firstmark. He joins us here at the NASDAQ. Rick, great to see you.
Great seeing you again. Great being back on set.
Great to have you on set in person. In terms of rising rates, how does that play into how you deploy money and how you value companies right now?
It's really affecting everything. You know, in the last 25 years I've been doing this, you haven't seen a more tumultuous time. There's no IPOs on the road, no IPOs testing the waters now. And what you're seeing is that's going to continue to decrease until rates settle. And as if there's no IPOs, there's no liquidity. If there's no liquidity, there's often not much more capital to invest. So it's really bringing the market to a halt in the private markets.
You've got money to deploy. And I'm wondering, you know, in terms of private market valuations and companies that you will invest in, how are valuations holding up? Because on the one hand, you hear about companies, you know, they don't have access to capital. They need the money desperately. But then you've got, you know, examples like a Figma, which is bought at a huge premium. So what's the deal here?
Figma is not what's going on in the market.
That's what
Figma is an aberration, but we're seeing a market close both for public financings and largely on the M&A side. The large public tech companies are afraid to buy folks both for regulatory reasons and also they're unsure of their own valuation. So in a world where the valuations are moving all around, there's not the stalking horse of an IPO where I could say, hey, I'm going to go take this company public if you don't buy me today. Like, yeah, go try it. Maybe in 2023 we could come back. There's not much going on, and the lack of liquidity is further cutting off that oxygen for emerging companies.
All right, so Rick, you have this capital to deploy. You just raised a fund, and you know the history of VC is like these tumultuous times, there's like mega trends that come out of them, right? If you go back and you think in the wake of the financial crisis, there was a convergence of mobile, social, and broadband, that sort of thing, and you guys made some great investments. What are some of the mega trends you're focused on right now?
So I think you're right. This is a great time to start a company. You're seeing more talent come together. You're seeing a more reasonable culture of thrift being built in companies built out of recessions. So we're excited. We signed 2 term sheets in the last week at companies at very normalized valuations. So the mega trends that we're seeing, though, is an ongoing march on the enterprise side of AI and artificial intelligence and machine learning driving enterprises. That trend's really going to play in over the next cycle because it's also a return on investment cost-cutting analysis. On the consumer side, we're still seeing a growth in games and even a disruption in major categories like healthcare with companies like Roman and financial services with companies like Extra.
It's interesting you mentioned rates being a factor, but it's not the absolute rate. I mean, obviously that makes a difference, but it's the volatility around it. But there's no signs that this is, and we're almost 2 years into a ridiculously absurd volatile bond market, and I don't see it abating anytime soon.
It's not, and until it abates, you're not going to get to normal rules of the road, right? So whether it's on the M&A side or the financing side, where valuations come out is a function of having some rules of the road, and how high are interest rates going to go, what does volatility mean, and therefore people feel comfortable valuing new IPOs, and otherwise they're still focused on all the money they lost on last year's IPOs.
It sounds, Rick, and it's the last question because the producers are saying wrap. It sounds like it's really, really hard to think about valuations on the public market side. And so I'm wondering, you know, when you see people make the case that it's time to get in on a X, Y, and Z company, is it just too early because of all the volatility out there?
It depends on how long your time horizon is. You know, we pride ourselves on taking the longest view in the room and having an ultra long time horizon. So if we're investing now at the seed or Series A or the earliest stages, it's a great time to get in because we know it's going to be 5 to 10 years before we have to get to liquidity. If you're a growth investor, it's a really difficult time because you don't know if that's going to be 6 months or 6 years till you're able to get liquid.
Rick, great to speak with you. Thank you for coming
Always
by.
great.
Rick
Thank
Heitzmann
you.
of Firstmark. That gets at the problem that investors have, right? Particularly growth investors, the higher multiple areas of the market. What price do you pay for that at this point, Karen?
Less, for sure, right?
Well, yeah, less for sure, but
right.
When is the right time? What's the right multiple?
That is such a good question. I think that it's sort of like, what will the market bear? Right. You used to be able to put some deck together and you never do a down round and all of that. And I'll bet that dynamic has changed dramatically.
I would just say, Rick even mentioned the Figma deal, or you mentioned the Figma deal, Mel. And so you also get opportunities from dislocation. I bet Guy's got an opinion because you've been talking about this company for years, but that move in Adobe, I think is extraordinary. I think it's overdone. And I think, although, software companies are tough, and then there's companies like Snowflake or Datadog, or companies that are making money right now that actually have been destroyed. So I think these are the places you want to be at least picking over.
Adobe's interesting, right? I mean, that's a stock, we've talked about it for years. The run-up it has in earnings, the subsequent sell-offs, this last one has been dramatic. I mean, Dan actually flagged this a few times over the years. But to Tim's point, it's an extraordinarily important company, which still not where it needs to be. Getting a lot closer, as a lot of these names are, by the way, which is a good thing. I mean, all this, as painful as it is, it's a necessary evil.